Welcome to Breaking News to Trading Moves. So, what does a shopper deciding to put back, like a premium box of cereal at Target, have to do with a trillion-dollar semiconductor company like Nvidia?
Right. I mean, at first glance, it really doesn't seem connected at all.
It doesn't. But today, we're looking at an upcoming earnings week that actually connects the local grocery aisle directly to the global artificial intelligence data center boom.
Yeah, we have a pretty thick stack of corporate earnings reports and retail data in front of us.
We do. We are featuring companies like Nvidia, Walmart, Home Depot, Lowe's, Target, TJX, and Ross Stores.
And you might be wondering why we are grouping a highly advanced semiconductor company with the exact same places where you buy your groceries and, your power tools.
Exactly. It sounds like a mismatch.
But there is actually a very clear thread tying all of these reports together. We are looking at the realities of consumer and corporate spending right now.
Right. And our goal for you today is to look at the headlines for these specific companies and then examine the potential winners and losers based on all this data.
Which is really the best way to approach a week like this.
Yeah. So as you listen, the overarching question to keep in your mind is this. Can these companies confirm that the AI boom and the U.S. consumer are strong enough to support current valuations?
Because that is the ultimate test for the market right now.
It really is. So let's get right into the biggest headline on the board. Nvidia. The market is treating Nvidia's upcoming earnings as a major test for the entire AI trade.
Yeah, it acts as the ultimate barometer. I mean, Nvidia sits at the absolute center of the AI chip data center and infrastructure boom.
They are essentially the engine of the whole thing.
Precisely. When they speak, they are giving us a read on corporate capital expenditure across the entire technology sector. We're looking at expectations versus actual reported demand.
Because it's not just a few $1 million here and there.
Oh no, you have to remember these tech giants are pouring billions into building out infrastructure, and Nvidia is the primary beneficiary of that spending.
Okay, so let's talk about the potential winners here. If Nvidia comes out and reports strong demand for chips, data center products, and gives strong future guidance, who actually benefits?
Well, if they set a positive tone, traders are going to look for related winners across the entire hardware ecosystem.
Like who? Exactly.
We are talking about semiconductors, networking chips, memory, and infrastructure.
Yeah.
Because an AI data center is, it's highly complex.
Right.
If you are building a cluster to train a massive language model, you're linking together tens of thousands of individual processors.
Right. They don't operate in a vacuum.
Exactly. If Nvidia is selling more processors, those processors need an immense amount of high bandwidth memory to function without bottlenecks.
So they need the supporting cast to keep up.
Yeah, and they need specialized networking components to talk to each other at lightning speed. Otherwise, those expensive processors just sit idle, waiting for data.
Which nobody wants. So let's list out the tickers for those potential winners so you can follow along. You have NVDA, which is NVIDIA itself. Then AMD, Advanced Micro Devices, which operates in a similar space and offers competing alternatives.
Yep.
You also have AVGO, Broadcom, which is absolutely crucial for those specialized networking chips we just talked about. And MU, Micron Technology, which provides the high-performance memory.
Yeah, so if the hardware demand is real and sustained, those specific companies are positioned to capture that ongoing capital expenditure.
Because there's nowhere else to go for these parts, right?
Right. The supply chain for AI hardware is incredibly tight, and these companies control the critical choke points. If the overall spending environment remains robust, the capital flows directly to them.
Okay, but let's flip the coin because we also have a list of potential losers. Yeah. And the first name on the losers list is, well, it's NVIDIA again, NVDA.
Yeah, it is.
Along with SMCI, Supermicrocomputer, ARM, ARM Holdings, and PLTR Palantir.
But wait, I need to pause you right here. NVIDIA is on the winners list and the losers list.
Yes. And I know that sounds contradictory, but this highlights exactly how valuations work in practice.
Okay, explain that. The biggest risk for these high-expectation AI stocks isn't that NVIDIA has bad numbers or that companies suddenly stop buying chips.
Right.
The risk is simply that expectations are too high.
I think of it like a pole vaulter. Like, imagine you have a world-class athlete. They clear the bar at 20 feet, which is an incredible achievement. The crowd goes wild.
Absolutely.
But the next time they jump, the judges raise the bar to 21 feet. If they only jump 20 feet again, which again is an amazing jump in reality, they fail the event.
That's a great way to put it.
Right. So if NVIDIA reports strong figures, but traders still sell the stock because the forward guidance or the profit margins didn't beat the already elevated expectations, does that mean the market is punishing success?
Well, that is a perfect way to visualize it, but it isn't punishing success. It is just adjusting to mathematical reality.
Mathematical reality.
Yeah. A stock price represents the sum of all future cash flows discounted back to today. So for companies like Nvidia, SMCI, ARM, and PLTR, the current stock price already assumes near flawless execution and massive continuous growth for years into the future.
So perfection is already the baseline.
Exactly. Let's say analysts expect a company to grow revenue by 50% and they deliver 45% growth.
Which is still huge. I mean, 45% growth is an incredible business achievement.
Right. But if the valuation required 50% to make the math work, the stock is suddenly too expensive.
Ah, I see.
If Nvidia's commentary on future demand or their profit margins just meets expectations instead of blowing past them, traders will adjust their models.
So the numbers can be objectively great, but if they don't clear that raised bar, traders will adjust their positions and the stock can become a loser on the day.
That's exactly it.
Which illustrates why this week is such a strict test. We are testing whether the underlying business reality matches the heavy price tag the market has put on it.
Right.
But Nvidia's corporate clients aren't buying these chips in a vacuum. Ultimately, the cash funding this massive AI build-out has to come from everyday people paying for subscriptions, software, or targeted advertising.
Yep, it all flows down.
Which means if we want to know if the tech valuations hold up, we actually need to look inside a household budget.
That is the logical next step. It is the exact same mechanism of testing valuations, just applied to a different sector.
Right.
We are measuring whether current retail valuations hold up against the reality of everyday household spending.
Because consumers are clearly still dealing with higher prices across the board. So let's look at the winners in the retail space. Based on the analyst notes, we are focusing heavily on off-price and value retail.
Right. When inflation pressure persists and higher prices eat into household budgets, that environment naturally supports retailers offering value, discounts, or essential goods.
It forces people to change their habits.
Exactly. Consumers become highly strategic about where their money goes. They prioritize needs over wants, and they actively hunt for ways to stretch their capital.
Okay, so the tickers to watch here are TJX for TJX companies, ROST for Ross Stores, WMT for Walmart, and COST for Costco. But wait, let me push back on something here. When we look at a giant like Walmart, isn't their scale so massive that they can negotiate lower prices from suppliers anyway?
They absolutely can.
Doesn't that skew the data we are looking at when we try to gauge the broader consumer?
That is a really great point. Walmart absolutely uses its scale to dictate terms to suppliers, which allows them to keep prices lower than competitors.
Right.
But what investors are looking at isn't just the price on the shelf. They're looking at basket composition.
What do you mean by basket composition?
WMT gives investors a direct, real-time read on grocery demand and price sensitivity. By looking at Walmart's numbers, we can see exactly how household spending behavior is adjusting in real time.
Oh, you mean looking at what specific items they are actually putting in the cart?
Precisely. Are people buying the store brand cereal instead of the premium name brand? Are they buying smaller pack sizes of chicken?
Are they skipping the name brands entirely?
Right. Or are higher income shoppers suddenly showing up at Walmart to save on groceries?
Yeah.
It is a literal window into the consumer's wallet.
That makes a lot of sense.
If Walmart reports that their grocery volume is up, but their general merchandise, like electronics or apparel, is down, that tells traders the consumer is highly focused on necessities.
And then you have TJX and ROST. They tell a different but equally compelling story about clothing and home goods.
Yet TJX and Ross Stores show us whether shoppers are actively trading down.
Give us an example of how that looks.
Well, let's say someone usually buys their clothes at a premium department store, but their monthly budget is stretched tight by higher grocery and housing costs.
Right, the essentials.
They still need clothes, but they might start shopping at off-price retailers instead to find those name brands at a discount.
So if these companies report strong numbers and increased foot traffic, it confirms that the consumer is actively seeking out discounts to make ends meet. Which brings us to the potential losers in the retail space. Full price and discretionary retail. This includes TGT for Target, M for Macy's, KSS for Kohl's, and BBY for Best Buy. Target is reporting this week, and investors are watching very closely to see if they can restore top-line growth.
Because if the value retailers are the winners, The full-price discretionary retailers naturally face headwinds.
Right.
When we talk about discretionary retail, we're talking about the items you might want, but don't strictly require for daily survival.
A new television, premium apparel, maybe extra decorative items for the living room.
Exactly.
Picture your own shopping cart for a second.
Right.
Let's say you are walking through the aisles at a big box store. You put in the bread, the milk, the cleaning supplies, the absolute necessities.
Right. The stuff you have to buy.
But when you get to the electronics aisle or the premium clothing section, you hesitate. You calculate the receipt total in your head, and you decide to put that extra item back on the shelf.
We've all been there.
Right. So my question is, are consumers stopping their spending entirely, or are we just seeing a targeted rotation away from those discretionary items towards strict essentials and discounts?
The data strongly points to a targeted rotation. It really just comes down to price sensitivity and the reality of a fixed budget.
Right.
Consumers have a set amount of capital to deploy each month. If a larger percentage of that capital must go toward higher-priced essentials like food and energy, there is simply less left over for the extra items.
So they aren't necessarily hoarding cash. The cash is just being absorbed by the necessities.
Right. And you have to realize retailers rely on those discretionary items for their profit margins.
Oh, because groceries don't make them much money?
Groceries typically have razor-thin margins. A retailer wants you to come in for the milk, but they make their real profit when you wander into the apparel section and buy a sweater.
So if consumers are actively choosing discount retailers to stretch their dollars, or if they are only buying the low-margin necessities, full-price discretionary retailers remain under intense pressure.
Yeah. It isn't that people have stopped participating in the economy. They're just participating differently. They're optimizing for value.
Optimizing for value, that makes complete sense. And actually, it leads us perfectly into our final category, which takes this concept of consumer pressure and applies it to a very specific high-ticket retail category.
Right.
We are talking about housing and home improvement, specifically the renovation standoff.
This is where the macroeconomic environment directly hits specialized retail. We are looking at companies heavily tied to the housing cycle, like Home Depot and Lowe's.
Okay, let's start with the losers in this category, or rather why this is such a tough environment overall. The tickers here are HD for Home Depot, LOW for Lowe's, WHR for Whirlpool, and RH for RH.
The negative pressure here is very clear, and it stems directly from the housing market dynamics.
Yeah.
Fewer Americans are moving or renovating right now due to the lock-in effect of current mortgage rates.
Right, explain that lock-in effect for us, because it really is the engine driving this entire retail segment.
Sure. So a few years ago, millions of homeowners locked in fixed mortgage rates around 3%.
Which is incredibly low.
Historically low. Today, rates are substantially higher. So if those homeowners want to move, they have to give up their cheap debt and take on a new mortgage at a much higher rate.
So they stay put.
Exactly. They are financially locked into their current homes.
And when people don't move, the transaction chain breaks.
Precisely. Because when people buy a new house, that single transaction triggers a whole chain of other purchases.
Like what?
Well, you buy a new house, you realize the kitchen is outdated, so you buy a new refrigerator from Whirlpool. You realize the living room layout is different, so you go to RH for a new sofa. You decide to paint the bedrooms, so you head to Home Depot.
Right. It's a domino effect of spending.
Yes. So the lack of housing turnover directly chokes off demand for home improvement products, appliances, furniture, and all renovation-linked categories.
So people are just making do with what they have because the costs of moving or, taking on a large-scale debt-funded renovation is just prohibitive for many households right now.
Yes. The big-ticket projects are being delayed indefinitely. You might buy a new shower head, but you aren't gutting the entire bathroom.
Right. So that paints a pretty bleak picture for that sector. But just like with Nvidia, we have a glaring contradiction here.
We do.
Because HD for Home Depot and LOW for Lowe's are also on the list of potential winners.
Yep.
Along with SHW for Sherwin-Williams and MAS for Masco. They are positioned as potential rebound plays in the analyst notes. How can a retailer be a winner and a loser in the exact same economic environment?
Well, it goes right back to our earlier discussion about the pole vaulter and the bar of expectations.
Oh, okay.
For Nvidia, the bar is set incredibly high. For Home Depot and Lowe's, the bar is currently set very low.
Because everyone already knows the housing market is essentially frozen.
Exactly. The reality is a tough housing environment, which makes them losers in terms of current sales volume. Sales have been under pressure for multiple quarters.
So the market expects bad news.
Right. The market has already priced in the fact that fewer people are moving and large projects are on hold. But because expectations have been lowered so aggressively, any mere sign of stabilization could act as a positive catalyst for the stock price.
Oh, wow. So they don't even need to report massive growth. They don't need to say housing is booming again. They just need to say things aren't getting worse.
Right. It is all about the rate of change. If Home Depot says foot traffic is down 3%, but last quarter it was down 6%, the rate of decay is slowing.
The bleeding is stopping.
Yes. And traders look ahead. If the earnings give investors a fresh view that demand is finally flattening out rather than continuing to decline, that could support a wider housing-linked trade.
I see.
Traders might view them as rebound winners because the worst of the pressure is theoretically already reflected in the current stock valuation. It is all about the delta between what is expected and what is actually reported.
That is a fascinating dynamic to watch, the interplay between the actual business environment and the psychological expectations of the market.
It really is.
So let's summarize the core takeaways from everything we have covered today. This entire week is a strict test of valuations.
Very strict.
On one side of the spectrum, we have Nvidia acting as the ultimate test for the AI trade, where expectations are sky high and hardware demand needs to be near perfect to support the stock prices of Nvidia, AMD, and others.
And on the other side, we have the consumer facing persistent inflation pressure.
Right.
We are watching the clear divide between value retail, like Walmart and TJX, which are capturing the trade-down consumer, versus discretionary full-price retail like Target, which is fighting to restore growth as buyers prioritize essentials.
And right in the middle of that consumer pressure, we have the stalemate in home improvement, where the bar is set so low for Home Depot and Lowe's that mere stabilization in the data could trigger a rebound trade.
Yeah.
It is all about finding where the realities of demand intersect with the prices the market has set.
It is. And as we wrap up, I want to leave you with a final thought to ponder, bringing these two seemingly different worlds together.
Okay, let's hear it.
We have established that consumers are actively trading down to manage higher prices. They're buying the store brand at Walmart instead of the premium brand. They are holding off on large renovations, and they are putting the discretionary items back on the shelf to balance their budgets.
Right. The everyday consumer is clearly budget constrained.
But consider this. Those same everyday consumers are the ultimate end users of the digital services that are being powered by the AI data centers.
Oh, wow.
The software, the apps, the targeted advertising, the subscriptions that utilize this massive enterprise AI infrastructure rely eventually on consumer revenue.
That's a great point.
So the question is, at what point do strict consumer budget constraints begin to test the seemingly unstoppable demand for enterprise AI hardware?
Yeah.
If the consumer is scaling back on buying premium physical goods, how long can the tech sector continue to accelerate its spending on digital infrastructure before the math stops making sense?
That is a brilliant question to keep in mind as these reports roll in over the coming days. It is all connected, from the data center architecture straight down to the shopping cart. Please note, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.